Hi, I'm Tekoa Da Silva with Sprott Global Resource Investments, and I'm sitting down here today with Mr. Rick Rule, CEO of Sprott US Holdings. Rick, good to see you.
Always a pleasure, Tekoa. Thank you.
Very happy to be sitting down with you, Rick, and a few things I want to ask you about today. It relates to the macro picture on markets from your viewpoint as a creditor. For the viewer, if they're joining us for the first time, you've been a creditor to the natural resource exploration and development stage market, from what I understand, your entire adult career. I remember in late 2015, you explained to me that there were some very attractive resource equity valuations in the market where things could be bought for below cash. And here we are now in late 2017, and from your viewpoint as a creditor, what is the state of the resource market today? What are the attractive themes, and how do we not lose money?
Well, from an equity investor's point of view, I would suggest that we're up off the bottom, which suggests that some of the easy money that we made in 2016 has passed us. But I do believe that the big money is ahead. The truth is that the resource businesses at current industry costs and current industry prices is still in liquidation, which means that either resource commodities cease to be available to the society at large, which is unlikely, or the prices go up, which is much more likely. So I think that we're early on in an equities bull market. From a lender's point of view, you look at this from two perspectives. In 2015, share prices were so low that equity was extraordinarily expensive, and many companies that had decent assets had to borrow because the cost of equity was too high. So it meant that as a lender, I wasn't competing with equity investors in the stock market. On the other hand, with equity prices lower in 2017, the companies that borrow from me have an easier ability to raise equity, capital that goes in front of mine and takes more risk. So I would say that from a lender's point of view, you look at a bull market with two different lenses. The existing loans that you have become markedly safer, and the equity kickers that you might get as a consequence of being a distressed lender are monetized more quickly. On the other hand, the loan terms are better, and your need to compete with dumb money, some of the equity investors, is more problematic in good markets. So it's a mixed blessing.
Would that also suggest that in good markets, a better market that we may be in now as compared to 2015, that for the equity investor, that their risk may be higher without being
yes, of course.
Selective?
Yes, of course. Absolute valuations are a speculator's best friend. And the type of equity valuations that we saw in 2015 were extraordinarily low. The idea that you could buy the best mining financier of his epoch, Robert Friedland, with two Tier 1 deposits at a discount to cash. In other words, you got two once-in-a-decade discoveries, and the best mining promoter on the planet at a discount to free cash is as close to an equities investor's nirvana as you get. On the other hand, in 2015, you didn't know when the market would recover. So in terms of making a time value of money calculation, you were guessing. We're off the bottom. We're in the beginnings of a bull market now. So although the values aren't as extraordinary, the time frames, the anticipated time frames in terms of the returns, in terms of a payday, are much more proximal now than they were then. And for many investors who seem to have trauma holding stock over a long weekend, these are much more generous times.
What are the specific segments of the space that you find most attractive right now in resources?
I think it depends on the nature of the investor and the speculator. I personally have longer time horizons than many, despite the fact that I'm old. It's ironic that as I have less time on earth, I become more patient, but I digress. So for me, the sectors of the market that are attractive are the sectors that nobody else occupies. Agricultural minerals would be an example. Uranium would be an example. I'm perfectly willing to wait 2 or 3 years for a 10-to-1 payday. But I have to say that the part of the market that attracts most people, the precious metals, seem attractive to me too. Yes, they're up off the bottom, but no, they aren't widely owned. And as their attraction becomes more evident, as a consequence of factors that I see playing out in the economy, I think there's still a spectacular payday ahead of us in the precious metals and the precious metals equities. I think it's easier to talk to people in sports parlance by saying that in the broader resource markets, we're in the first inning of a 9-inning game, and in the precious metals markets, we're in the third inning of a 9-inning game, up off the bottom, but already into the game, with the payday coming more quickly. So I think that question, the answer to that question, pardon me, really depends on the nature of the individual that's considering the question.
Mm-hmm. Rick, I'd like to ask you this question in regards to the resource space, and then after the general equity market as a whole, thinking about the ultimate sale when you go to bed at night and you think about that possible opportunities that could be there the next morning. What do you envision? Some people may think of a crash, but if we looked at it from the standpoint of a sale, what's the ultimate for you?
I hadn't thought about that question. I'll attempt it. I have by now been through, depending on how you count, 4 or 5 precipitous declines in the market. And I talk about, I guess what you're talking about in terms of a sale is an opportunity, not when I sell, but when the rest of the world sells to me. My experience has been that goods are on sale when there's investor capitulation, and goods are dirt cheap when there's professional capitulation. In professional capitulation, you see the best and the brightest people who are managers or owners leaving businesses and going away. And you saw that in 2015, although not to the extent that I would have hoped we would have seen it. A different type of sale that we might see in this circumstance, that is, a sale is not specific to resources, would be some kind of liquidity crunch of the type we saw in 2008. It's interesting that from my point of view as a credit analyst, the entire set of circumstances which was in front of us in 2008, misallocation of credit, speculative activity on the parts of lenders, unsafe government balance sheets, unsafe private sector balance sheets, incredible use of derivatives, they're all present today. None of the circumstances that surrounded the liquidity crunch of 2018, from my own point of view, have been addressed by anybody. And my nervousness in this market is that the investing public is mistaking solvency, the fact that there's cash in this, or liquidity, pardon me, the fact that there's cash in the system, with solvency. The fact that our debts are very large relative to our ability to service these debts. So if you're asking me what a sale might look like, the thing that always sticks in the back of my mind is if we haven't cured the conditions precedent for the 2008 collapse, liquidity crunch, might we be facing it again? Many people didn't see the black swan in real estate finance in 2008. I myself recall driving on the 405 freeway in West Los Angeles, probably 2007, maybe 2006. And I'm not a real estate specialist by any means, but I remember seeing a large billboard, advertising board, on the east side of the 405 freeway heading north. And it said, borrow 125% of the value of your home. Bad credit okay. And I remember thinking, now I'm not a real estate lender, but I don't think this has a happy ending. And I wonder how many other circumstances are out there right now. Little hints like that billboard that say, despite the fact that the sun rises in the east and sets in the west, all is not well. One example would be in our country, Tekoa. People seem to be completely sanguine about the fact that at the federal level we have $20 trillion in on-balance sheet liabilities at the federal level. Trillion is such a big number that people don't relate to it. But if people write down $20 trillion, you do a 20 and then a bunch of commas and 12 zeros. Trust me, it's a lot of money. They also appear to be sanguine about the fact that off-balance sheet liabilities, and most people don't know what those are, off-balance sheet liabilities are reputed by the Congressional Budget Office to exceed $100 trillion. dollars. And by the way, I can personalize off-balance sheet liabilities. I'm 64. Next year I'll be 65. I become one. Social Security, Medicaid, Medicare, the Superfund liabilities, these are off-balance sheet liabilities. They aren't a bond in a sense, they're just promises that we've made between ourselves. But of course, it gets worse. We're here in the People's Republic of California. And in addition to that, in San Diego County, which each have their own fiscal challenges, which aren't part of that 20 trillion or $100 trillion numbers. And besides that, of course, many pension schemes in the country, government and private, are defined benefit rather than defined contribution schemes. As I understand it, the average assumed investment return on these schemes is about 7.5%. That's how they figure out their actuarial obligation. And the median return in the last 5 years has been 2%. What that means is that the pensions that have been promised to many workers exceed by a substantial margin the amount of money available to pay them. Is this pension obligation, are these liabilities that we face at the federal, state, and local level the same as the crisis that we faced in 2008 with regards to real estate securities? On the one hand, they're more diffuse. On the other hand, they're larger. A black swan, by definition, is something that you haven't seen, something that's very rare. But if I were going to point to an ultimate sale, I would suggest that the ultimate sale would have to do with a lack of faith in the ability of federal, state, and local governments in the United States to meet their obligations, their so-called obligations, off-balance sheet obligations to their citizens, and their inability to refund the debt that makes up those enormous deficits.
Rick, as a creditor, a lender, how do you manage your inventory? Inventory being cash, and thinking about sudden sales. Also, based on your experience as a lender, how prepared are people really, your competitors, for sudden sales based on your experience?
I'll answer those questions in reverse order. The competitors that I know well, the people that I've competed against for 35 years, who are still solvent enough to be competitors of mine, are a fairly prudent lot. And they are quite cashed up, as I am. I'm cashed up for two reasons. The first has been a smaller population of opportunity than I would have expected, given where we are in the market. The second is because I've had periods of time in my life when I had a lot of cash and periods of time in my life when I didn't have a lot of cash. And I found I was happier when I had a lot of cash. So I'm cashed up both tactically and strategically. What I found with regards to cash is, in addition to being good for the nerves, and that's important, is that it gives you both the tools and the courage to take advantage of financial distress. And so in the accounts I manage, and this is unfortunate, I'd like to be more invested, but in the accounts I manage, I'm as much as 40% in cash. I've had worse problems.
In thinking big picture with this next question, Rick, what is being a contrarian to you in regards to the marketplace, and how do you go about being a contrarian today?
You know, Tekoa, that's a great question. I describe myself as a contrarian, and I am a contrarian, but I struggle with the contrarian paradigm every single day. All of us, yourself and myself included, believe that we're fact seekers. We believe what we do is we source from various channels information, and we assemble the information and we dissect it and analyze it rationally and draw conclusions from that information. But that's not what we do. We certainly seek input from many places, but we seek input that makes us comfortable. We seek input that reinforces our existing paradigms and prejudices. The truth is that we assign most relevance to information that's at once comfortable and also familiar to us. So our experience in the immediate past governs our expectation of the future. It's one's ability to think beyond that, A, in terms of time, but B, in terms of arithmetic as opposed to narrative, that makes one a contrarian. Think about this. The uranium business is a horrible, horrible business. The International Energy Agency believes, on a worldwide basis, it costs us $60 a pound to make uranium, and you sell it for $20 a pound. So you spend billions of dollars to lose $40 a pound, and being miners, of course, you make it up on volume. A horrible business. Horrible business. If you think beyond where we are to where we have to be, however, we have one of two choices. Despite the fact that most of the world hates uranium, equates it with 3 Mile Island, Hiroshima, Nagasaki, Fukushima. The truth is that even in the United States, which can afford to be picky about their power sources, uranium provides 16% of baseload. So there's really two choices. Either we use uranium on a continuing basis or the lights go off. If we're going to use uranium on a continuing basis, the price has to go back to the cost of production. So a business that to a rational observer of yesterday, the immediate past, the uranium business is a horrible business because an investment in a company that loses $40 a pound on 2 million pounds is horrific. To someone who is a contrarian and forward-thinking, the fact that either the uranium price triples or the lights go out within 5 years presents a sterling opportunity. The contrarian is the one who observes fact and thinks about what must be, rather than the person who observes immediate history and thinks merely about what is.
Do you see a tendency of maybe a crowd follower to more often consider an if question as opposed to a when question? Because I know that's a theme that you continue to remind myself and others about, thinking when, not if, in some circumstances.
I'm not sure that the crowd follower, which I would categorize as a momentum speculator, is necessarily the only culprit there. Most speculators, if they have a flaw, and most of them do, look to their upside before they look to their downside. Certainly, most speculators speculate in what's popular. You'll notice that Bitcoin, as an example, had moved from 400 to 2,000 before anybody cared. And then, of course, it gained tremendous attention, which is normal. If is what captures the imagination. If is what, if it comes true, generates 20-to-1 returns. If only becomes interested to people, though, when the narrative has begun to play out in the market. In the early part of the last decade, when the gold price moved up from $260 an ounce to $1,900 an ounce, gold didn't come to popular attention until it had moved past 1,000. In other words, it moved from $260 to $1,000 before people allowed the fact that the price had gone up to substantiate the narrative. When gold moved from 1,000 to 1,900, people started asking themselves if questions. If we began to have sovereign defaults, if there was a trade war between the United States and China. All those ifs were there when gold was at 260. It's just that the recent experience to enforce the narrative that has the people ask the if question takes away at least half the value of the yes answer, of the if answer.
Rick, what might be one market event or economic that you hope to see within your lifetime?
Oh boy, narrowing it down to one. Your audience is going to hate me for this. I'd love to see a sovereign default. I would love to see the system of lies that we live in, including the lie that we have to each other that's implied by the US dollar, be shown to be a lie. Certainly a tumultuous circumstance, and one that might change my standard of living for the worse in the sense that social chaos might develop. But if you are allowing me to express myself in a way that isn't merely economic, but also philosophical, something that exposed the lie of government and taxation and the lie manifest by government debt and fiat currency, I would love to see that in my lifetime.
In wrapping up, Rick, once again from a macro perspective, do you think there's anything we may have missed?
Oh, lots and lots and lots of things, Tekoa. Mercifully, you're young, and we'll have many more discussions like this. So let's leave that until it becomes obvious to both of us.
Rick Rule, CEO of Sprott US Holdings, thanks for sharing your comments with us.
Thanks for arranging this. Thank you.